since obviously this is a field hearing, so it'll be a little more informal than we might be in a regular hearing room. Mr. Renacci and Mr. Duffy and I will each give an opening statement, and then our witnesses will be recognized for a 5-minute opening statement, and then we're going to have a couple rounds of questioning where each member will be recognized for 5 minutes. We should be finished. Plenty of time for us to catch our flights back to Washington, and we're returning off after a 2.5-week Easter recess. And I haven't gotten a chance to really compare notes with my colleagues, but I certainly did in my 2 weeks home. Got a lot of feedback where concerns are, where people are questioning what direction we're going, and a lot of frustration really and concern. So I hope that with the great witnesses we have today, we'll be able to dig down deep in some of this, at least in terms of the Financial Institutions Subcommittee. Over the past year, we have held field hearings across the nation to gain a better understanding of the unique challenges, can everybody hear me by the way? Okay, faced by financial institutions in different regions of the country. In Georgia, which has the highest number of bank failures since the financial crisis, and that presented very unique difficulties in Georgia. In Wisconsin, in Mr. Duffy's district, we heard from community banks, credit unions, and small businesses about ways to promote economic growth. I also went to San Antonio last month, where community bankers and credit unions also discussed growing burden, regulatory burden, and cost of compliance. And our most recent field hearing in Nevada provided me and other members with insights into private sector solutions to mitigate foreclosures. They have an enormous issue with their real estate in and around Las Vegas and the whole state of Nevada. Each hearing has been a learning experience for me, further providing solutions to our nation's problems, and also reinforcing that those solutions aren't going to necessarily come out of Washington, D.C. They come out of the heartland of America. By the way, I'm from West Virginia, for those of you who haven't had a chance to brag about that. There are a lot of West Virginians here in Ohio, and I did say that if you all would just learn how to drive, we would feel a lot better about that. But please no West Virginia jokes, I don't want to hear them. This will mark the fifth field hearing for us, and I would like to thank Mr. Renacci for serving as our host. He is my vice chair on the subcommittee. He brings a wealth of experience and a broad-based business background that has been extremely helpful, not just to the committee, but to me in particular, and I want to thank him for that. We also have Mr. Duffy from Wisconsin, who is a freshman as well, and he has led the charge on some of our CFPB legislation and others, so I want to thank him for coming. Today we're going to continue the theme of the better understanding of the local environment of financial institutions. Our panel of witnesses will provide insight into the unique challenges faced by financial institutions of varying sizes. We'll hear from small community banks and credit unions about the regulatory impediments to promoting economic growth, and Key Bank will provide members with a better understanding of the unintended consequences of the Volcker Rule, the very complicated Volcker Rule. Finally, we'll hear from a community development financial institution about their efforts to spur job growth. As with other hearings, we're here to listen and learn, and I look forward to that. We normally have a timer, but I was just informed that the timing device is in California. I don't know what it's doing there, but there's another field hearing in California. So, and I left my watch in West Virginia when I left at 5:30 this morning, so I've got my dutiful staff back there to tap me on the shoulder. So if you hear me kind of wrestling around, you'll know it's time to move along a little bit. But I appreciate really everybody, the witnesses and the audience for coming, and I'd like to now yield to Mr. Renacci for the purpose of making an opening statement.
Thank you, Madam Chairwoman, and I want to begin by thanking you for holding this important hearing and for being gracious enough to hold it in the wonderful city of Cleveland. I also want to thank all the witnesses here today. I can't emphasize enough what a pleasure it is to be in front of a hometown crowd this morning. I am proud to say that Ohio is home to some of the finest financial institutions in the country, and I have no doubt these institutions are committed to helping our economy achieve a more robust and sustainable economic recovery. When I travel around the 16th district meeting with small business leaders, I find a frustrated group that is eager to expand their businesses but are prohibited from doing so because they cannot access the necessary capital. At the same time, the financial institutions in my district repeatedly say they are ready to extend credit, to these small businesses, but have the capital to do so, but are unable to because of overzealous, inconsistent, and ever-changing regulations. We are here today because cities like Cleveland and institutions like yours are the ones affected by Washington regulations. I believe part of the problem is that for too long, lawmakers have legislated from Washington with no real sense of how the regulations will impact people across the country. I have no doubt that most regulations are drafted with the best of intentions. The most problematic regulations are the ones that sound reasonable on their face, but taken cumulatively have a devastating impact. A perfect example is the Dodd-Frank Act. The drafters' intentions were noble: to prevent another financial crisis, improve transparency, stop banks from taking excessive risks, prevent abusive financial practices, and end too big to fail. Unfortunately, instead of sound regulation aimed at reining in fraudulent and destructive behavior, we ended up with hundreds of pages of hastily thrown together regulations. Instead of preventing the next financial crisis, we have managed to paralyze our financial institutions by creating a sense of uncertainty and confusion. Instead of sound regulations, we have left many of our financial institutions standing on the sidelines, unwilling and unable to provide liquidity to our markets because they are unsure what the rules are and when they might be unilaterally changed again. The uncertainty and cost of new regulations is having an especially profound impact on smaller institutions. Without a large compliance staff or back office legal teams, our smaller institutions are forced to divert precious capital to keep up with new regulations, capital that would be better used in the hands of its customers. That is why we are here today. I want to hear the issues being discussed inside our community institutions. I want to hear how regulations coming out of DC are impacting access to credit, how they are impacting your institution's ability to conduct business. I realize that many of you are tired of telling your stories. I know sometimes it seems like no one is listening. I want to assure you that we are listening and we care. Myself, Chairwoman Capito, Mr. Duffy, and many other members of this committee have heard from similar institutions across the country. And we recognize that your institutions are the key to our economic recovery. Thank you again for being here today, and I look forward to hearing your testimony.
Thank you, and now recognize Representative Duffy for the purpose of the opening statement.
And it's an honor to be here in Cleveland. This is my first trip to Cleveland. So I only got to see it about 12 o'clock last night until this morning, but what I've seen so far, fantastic. It's also great to be here with Chairman Capito. She's done a fantastic job leading our committee, but also to be here with Mr. Renacci as part of the freshman class. We serve on financial services together, but also as a freshman class, he's one of our greatest leaders and does a fantastic job moving this herd of a freshman class, driving us forward, and is respected by everybody, and is, again, one of the best leaders we have, so it's a privilege to be here in Cleveland. Today, you know, I come from Central and Northern Wisconsin, and I have a chance to talk to our small banks and our credit unions time and time again, and I keep hearing the same thing over and over, that the regulations are killing them. It's making it harder for them to do their business, to do their jobs, to get capital out into their communities. They talk about regulations that are stifling their communities, stifling their businesses. They talk about the regulators coming in and these outrageous reviews that take place, and the standards are changing from one regulator to the next, you know, year over year. And the outcry has been quite loud. And I guess I'm interested today to see if you guys have the same stories that I hear in Central and Northern Wisconsin. And if it's just a Wisconsin phenomenon or if it's a phenomenon that takes place around the country. And I also like to hear if you guys have ideas for solutions. Obviously, we know we have to change the law and the structure. But if you go, you know, there's a lot to be done. But if you could really focus on this area first, that would do the most for us to help us do our jobs better. So I'm here with open ears and look forward to hearing your testimony.
That concludes our opening statement, so I'll introduce each witness individually, give them a chance, everybody 5 minutes, and then we'll get to the question portion. First, I would like to recognize Mr. Stan Barnes, who's CEO, CSE Federal Credit Union. Welcome, Mr. Barnes.
Thank you. Vice Chairman Capito.
I don't know if your mics are on or working. Is there a green light on?
Yes, there is.
There.
Thank you, Chairman Capito, and members of the subcommittee. Thank you for this opportunity today to represent Ohio's 377 credit unions and 3 million Ohio credit union members, and to share with you on their behalf the difficult circumstances facing community-based credit unions in the form of overburdensome regulation and lack of transparency in the examination process, and to update you on the current and future role of the credit union movement. My name is Stan Barnes. I am the President and CEO of CSE Federal Credit Union in Camden, Ohio. We are a $150 million not-for-profit financial service cooperative, and we proudly serve 3,000 members in the Northeast Ohio, 30,000 members in the Northeast Ohio area. And like every credit union, many are represented here today, we do so under the business philosophy of not-for-profit, not for charity, but for service. Regulatory burden and the cost of compliance, as you have noted, is the #1 concern among Ohio credit unions. Attached to my testimony and submitted for the record are the federal regulatory requirements of both banks and credit unions, which should put into some perspective the time, the effort, and the cost tied to compliance. In many cases, when credit unions should be dedicating resources to the financial livelihood and benefit of their members, they are instead challenged with the increasing burden of following far-reaching rules and regulations. And these regulations are particularly onerous on small asset credit unions, which are subject to the same regulations, but struggle to adhere to these guidelines due to thin operating margins, small staffs. In fact, the vast majority of Ohio credit unions, 65%, are small credit unions under $35 million in assets. To give you a sense of the increasing regulatory burden, since 2008, Ohio credit unions have been subjected to more than 160 new rules and regulations from 27 different federal agencies. Additionally, there are at least 27 rulemaking proposals pending at various agencies, including the National Credit Union Administration, the Federal Reserve, the Consumer Financial Protection Bureau, the Department of Housing and Urban Development, the Financial Accounting Standards Board, and the Treasury FinCEN, and the Federal Trade Commission, among others. Unfortunately, even though natural person credit unions that I represent did not cause the financial crisis, they have been subjected to a flood of regulation that create unnecessary burden without any measure of the effectiveness of the changes. With regard to examination standard and inconsistencies, the experience of the majority of Ohio credit unions is that the high standard of transparency and accountability expected of financial institutions is underwhelmingly practiced by the National Credit Union Administration during the examination process. Credit unions have voiced to the NCUA that their examiners are practicing regulatory micromanagement and overreach. Quite simply, regulators are dictating the business of operating a credit union. It is important that examiners not over-regulate or exceed their authority and substitute its judgment for that of the volunteers and the executives in the governance, management, and operations of credit unions. While the relationship that I enjoy with my examiner is transparent, professional, and rooted in mutual respect, colleagues of mine have experienced the exact opposite. I urge the committee to consider improvements in the examination process. H.R. 3461, sponsored by the chair, is a good step in that direction. It does address examination process and is a positive step in balancing the relationship between the regulated and the regulator. It also provides for a more transparent and consistent examination process. And I know that the Credit Union National Association, of which CSE is a member, supports the legislation and is working closely with the NCUA to incorporate examination enhancements and transparency. CUNA has also urged the NCUA to take several steps to improve the regulatory process and relieve credit unions' regulatory burden. I've submitted a copy of a letter from CUNA to NCUA Chairman Debbie Matz that recommends immediate actions to relieve overwhelmed credit unions. Credit unions have called on the NCUA to impose a moratorium on new regulations for at least the next 6 months and have suggested the agency reinstate the regulatory flexibility program, which provides well-managed and well-capitalized credit unions an exemption from certain regulations that are not statutorily required. Despite the issues caused by regulatory overreach and examination transparency, I am proud to say that credit unions continue to serve their members with responsible and affordable financial products and services. Over the years, credit unions have grown considerably and play an important role in the local community. In fact, research by the Credit Union National Association, which finds that credit unions save Ohio members $132 million annually by offering better priced, conservatively managed products and services. The not-for-profit cooperative model is working, and in my opinion, it is best suited to meet the needs of all Ohioans. I have submitted as part of my testimony examples of the credit union difference in action and how credit unions are helping Ohioans in today's economy through financial education. But credit unions can do more. With common sense regulation that would essentially double the arbitrary cap on small business lending, credit unions can infuse $13 billion of new capital into small businesses. We ask that you support S-2231 and H.R. 1418. Similarly, H.R. 3993, which would allow well-capitalized credit unions to receive supplemental capital, a much-needed financial resource as credit unions face a difficult revenue-building environment and increased pressure to perform by regulators. And we ask for your support of that man. We look forward to continuing to work with Congress to resolve issues facing community-based financial institutions. We ask that as you consider legislation in this arena, you regularly consult credit unions in your district. We want to be a solution to the economic issues facing our state and country, and we're here to help. Thank you for this opportunity to present to you this morning. I am happy to answer any questions that you may have.
Thank you, Mr. Barnes. Our next witness is Mr. Bill Blake, Senior Vice President and Associate General Counsel of KeyBank. Welcome.
Thank you, Congressman. It's a privilege for me to be here today.
You maybe move just make sure we get her. Yeah, that would be great.
Privilege for me to be invited here today to talk about the local rule and proposed regulation. KeyBank and other regional banks did a joint comment on proposed regulation several weeks ago. The letter was signed by Branch Bank and Trust Company, Capital One, Fifth Third, eCorp, PNC, Regions Financial, SunTrust, and First Bank. All of our institutions have one thing in common. Our primary mission is to serve our local communities by providing traditional banking services, deposits, loans, trusts, and asset management. We are regional banking organizations who share the same concerns about the local. We're not complex, local, interconnected businesses that Dodd-Frank is intended to address. Our organizations don't engage in proprietary trade, nor do we have any substantial interest in hedging funds or private funds. Congress does not intend to unduly restrict traditional banking and customer-facing activities or impose substantial compliance burdens on banking organizations primarily engaged in traditional banking activities. The proposed implemented regulations too often take a one-size-fits-all approach that results in unintended consequences. And in today's testimony, I'd like to highlight 4 areas in which the rule negatively affects our ability to serve our customers, manage risk, control costs, and avoid losses. We're concerned that the proposed regulation will actually increase rather than decrease the risks to safety and soundness of organizations. First, the proposal hampers our ability to meet the liquidity needs of customers, especially small and middle market companies. We have long provided liquidity through our market-making activities, market-making operations. Small and mid-market companies have security issuances that are relatively small in size and trade risk from large companies. Under the proposed rules, our legitimate market-making activities and less liquid securities face a substantial risk of being improperly viewed as illegal proprietary trading. The implementing regulations need to ensure that issuances of small and mid-market companies are not disadvantaged compared to larger companies. Second, effective hedging and asset liability management activities are critical to the way we manage risk and ensure soundness and safety of our institutions. The proposal fails to clearly protect qualified hedging and ALM activities. Organizations like ours will operate in a continuous zone of uncertainty, unsure of whether qualified hedging and ALM activities and trades will, on an after-the-fact basis, as determined by an agency, constitute invisible proprietary trading. Without the ability to execute our critical asset liability activities, banks will face scale back in traditional lending to risks associated with them cannot be appropriately hedged. Small and middle market businesses, as well as municipalities, may see a reduction in lending and may increase in borrowing costs. Third, our organizations are committed to maintaining strong and effective compliance programs appropriate to the size, nature, and complexity of our organization's activities. But the costly, detailed programmatic compliance requirements overrule both go beyond what is appropriate for regional banking organizations that do not in any way, meaningfully engage in trade and be proprietary. We do not believe our organizations need such programs to prove a negative. In fact, we don't proprietary trade. Instead, we think the overrule dollar threshold for programmatic performance should be raised from $1 billion to $10 billion. In fact, raising it to even $15 billion can still capture more than 97% of the total trading assets and trading liabilities of our U.S. banking organizations. Finally, the rule requires banking organizations to divest existing legacy investments in private equity funds. The purpose, subject to certain exceptions, the purpose of this extended period is to allow banks to unwind these investments in an orderly fashion without leaving fire sales. Most of these investments provide capital to small and medium companies. All the investments were legally made at the time they were acquired. What the rule now requires us to dispose of all of them. The rules as written will likely result in forced sales of private equity fund interests at distressed prices, which will transfer significant value from the regulated banking industry to private investors. The rules essentially negate the availability of the statutory 5-year period for running off public investments. The overrule provisions of Dodd-Frank are scheduled to go into effect on July 21, 2012, a little more than 3 months from now. The proposed rules generated over 17,000 comments. Academia, members of Congress, trade groups, public interest groups, and other interested parties. We and the growing cohorts of other interested parties believe that substantial revisions to proposed regulations are necessary. Accordingly, the final point I'd like to make is that our regional banking group strongly supports the effort being made on the nonpartisan group of senators, including Senators Craig and David, to delay the effective date of the estimated support commission. He, along with other regional banks and share, we filed a comment letter with the agencies on February 13th to explain our concerns and to submit a copy of our comment letter for testimony today. And I encourage you and members of your staff to consult it and get a better understanding of the problems that we face. I sincerely appreciate the opportunity to testify today, and especially thank you all for coming to Cleveland. We, regional banks, are committed to restore our economy and look forward to working with you. Thank you.
Thank you. Our next witness is Mr. G. Courtney Hanning, Chairman, President, and CEO of People's National Bank. Thank you. Welcome.
Madam Chair, Capito, Congressman Renacci, and Duffy. My name is Court Hanning, and I am the Chairman, President, CEO of People's National Bank of Lexington, Ohio. I am also Chairman of the Ohio Bankers League, and I'm here speaking on behalf of its members. The OBL is the only trade association in Ohio representing the full spectrum of insured depositories, including mutual thrift, community banks, and multi-state holding companies. Today, I'm here to focus particular attention on the challenges facing community banks. While larger banks care about their customers, they do not share the same vested interest in my community that I do. In many cases, we are the only economic engine in the area we serve. If my customer is forced to leave because he cannot find a good job, I cannot follow him. So my bank must closely align with local needs. My expertise is that I am a close friend to my customers, which gives me added insight. This means I can make more loans safely than my bigger competitors that rely on mathematical models. Many successful businesses in Ohio started with a close call on a loan made by a community bank, which could say yes because it knew its customer well. Unfortunately, this ability to exercise good judgment based on local market knowledge is being threatened by both recent reg burdens and inconsistent decisions by regulators. Most banks in the Midwest did not participate in the underwriting practices that contributed to the recent recession. Sadly, however, we are paying for the past through costly new regulatory burdens, anxious examiners, and customers that are unwilling to borrow. These remedies are hitting all parts of our financial statements as costs are going up, opportunities to earn revenue have been curtailed, and the amount and cost of capital we need is increasing. I know that your subcommittee has heard a great deal about the issue of too big to fail. That is an important problem. However, today I would like to talk about whether under the new environment, community banks have become too small to survive. While we see the cumulative effect of new regs and exam procedures, community bankers are concerned that policymakers don't understand that we don't have the same resources to meet new compliance demands of multi-state banks. There are numerous new record-keeping burdens set to take effect. For example, under the rules proposed by the SEC, banks will have to register as municipal advisors just to offer the same deposit and loan services we have always provided to local governments. The goal of the new statute was to provide oversight for advisors that fell in gaps between banks and security regulators, not to duplicate oversight for banks that are already regulated. Yet the proposed rule will add to our overhead without providing additional protections for consumers. Examiners have a hard job that is made even more challenging in difficult times. Yet there can be no doubt that examiners are becoming more rigid, leaving less room for judgment. This is particularly detrimental for local bankers, since our competitive advantage is our knowledge of that local marketplace. If the examiners take away that flexibility through a one-size-fits-all approach, it will handicap our ability to compete. For example, while fighting discrimination is an important goal of government, as a result of recent changes, we are now hesitant to loan to longtime customers if they do not qualify based solely on objective criteria. Now everyone has to fit in a box. If the customer doesn't fit, yet we approve the loan, that borrower becomes an exception. If we create such an outlier, we must justify the reasons for making the loan. Our examiners will demand similar exceptions for outliers and protected class, or the bank's risk referral to the Department of Justice for prosecution. As a result, bankers stop making exceptions. All banks and customers are different, so that it does a great disservice for examiners to create a one-size-fits-all. Finally, I would like to thank you for introducing H.R. 3461 to restore consistency to the bank exam process. We would encourage you and your colleagues to follow through and see that the good ideas in the proposal become law. I believe bankers and examiners still want the same thing, a healthy, vibrant, competitive banking system. The Financial Institutions Exam Fairness and Reform Act helped all parties achieve that goal. In conclusion, I sincerely appreciate the opportunity to testify here today and would like to thank members of Congress and their staff for coming to my home state to gather information on issues of vital importance. Banks have served this country well and will continue to provide a significant engine for economic growth and job creation if we are allowed to perform without excessive regulatory burden or inconsistent examinations oversight. We would urge House Representatives to continue on the path they started at the beginning of the 112th session of Congress. Hold bank regulators, including CFPB, accountable for the cost of compliance and ensure the layers of regulation do not accumulate to the point where it is no longer feasible for community banks to continue to serve their own markets.
Thank you. Our next witness is Mr. Steve Fireman, President and General Counsel, Economic and Community Development Institute. Welcome. Thank you.
Thank you. Chairman Capito, Congressman Duffy, and Renacci, thank you very much for having us. On behalf of the Board of Directors and staff of the Economic and Community Development Institute, we want to thank you for hosting this conversation regarding the challenges faced by Ohio's community-based financial institutions. The Economic and Community Development Institute is a 501c3 nonprofit economic development organization, the U.S. Small Business Administration intermediary microlender, the U.S. Treasury designated community development financial institution. Since 2004, ECDI has made $10.5 million in loans to around 550 local small businesses in central and southwest Ohio, creating and or retaining approximately 1,650 jobs. Because of our success in central and southwest Ohio, ECDI has recently been approached by funders and stakeholders in the Cleveland area and asked to expand our microenterprise development services to Northeast Ohio. The organization will open a branch in Cleveland in July 2012. In addition to filling the gap in the credit industry by offering loans ranging from $500 to $100,000 to small local businesses through our revolving loan fund program. ECDI addresses the needs of very small business owners in the creation and expansion of small business. Challenges. Our challenges are quite different than some of the challenges that are being discussed today. However, our popularity is a direct result of the challenges being discussed by the witnesses today. There's no doubt about that. First and foremost, we're faced with the challenge of demand for capital. As one of the few microlending organizations in Ohio, there has been an increased demand for ECDI to do business. As a young and dynamic organization, ECDI is committed to scaling up to meet the increasing demand. To meet the demand. Since 2009, ECDI has demonstrated consistent and dramatic growth in the amount of loan capital dispersed in the businesses served. In addition to seeing increased demand in our Central Ohio market, ECDI has expanded our services from 7 counties that we were doing business in 2009 to 49 counties currently, at the request of stakeholders, including the SBA, the Ohio Department of Development, and the aforementioned Cleveland Foundation. This surge in demand for small business loans, as well as the geographic expansion, has caused some challenges for ECDI. The first challenge we've faced is to keep up with demand for capital. At the end of 2010, ECDI's loan funds were nearly 100% deployed. ECDI faced this challenge head-on by creating an investment instrument approved by the Ohio Securities Commission called Invest Local Ohio. Invest Local Ohio gives community members the opportunity to invest in a small business by investing in ECDI. Every dollar invested in the Invest Local Ohio fund is loaned to Ohio small businesses and leveraged with at least $2 more from other existing ECDI loan funds. ECDI investors receive a 2% return on their investment for a 3-year note and 3% return on a 5-year note. Challenge number 2 is related but a little bit different. It involves demand on our capacity. This challenge is caused because in addition to outreach, assessment, training, processing, servicing loans, ECDI's model differs a bit from the banks and credit unions, and we commit to provide ongoing technical assistance to our portfolio, beginning with the loan and continuing throughout the life of the loan. We like to tell our customers that when you do a loan with us, it's like getting married. You're not going to get rid of us. This is a critical building to building successful businesses, and therefore we proactively work with clients to keep a healthy portfolio. This is also very, very costly. As an SBA intermediary microlender, ECDI receives a yearly allocation of technical assistance funds to spend time with our clients in building strong businesses and capacity. This is very valuable, but 75% of the funding is restricted to working with the clients only after the loan is closed. Not only is this a huge compliance-related burden associated with allocated and tracking staff time, very little of the SBA technical assistance allocation is able to be used working with potential loan clients before the loan is closed, and none of the funding is able to be used for general loan administration, such as underwriting, processing, and servicing. Another challenge that we have is the unpredictability of federal funding. I don't think I need to say much more about that, actually, but it's enough to say that every year we have to compete for our federal funding, CDFI and SBA money, which is okay. We appreciate competition. However, it's just a difficulty in building an organization to scale. You have to plan year by year as opposed to a few years out. Another challenge that we face, and this is very different from the other banks sitting on the witness table with me today, is that the philanthropic communities are not wired to think about small business development as a viable target for their dollars. According to a report from the Foundation Center entitled Spotlight on Economic Development Grant-Making in Ohio, although the amount of dollars granted to economic development initiatives by foundations in Ohio increased by 152% in the period of 2005 to 2008, grants specifically targeted towards small business development decreased by a third. Another related challenge, or similar challenge, has to do with state economic development initiatives. Just as traditional philanthropy is not wired to understand the importance of small business development, the majority of Ohio-sponsored economic development initiatives are not wired to understand the importance of microenterprise development. Instead, we focus time and money on traditional economic development strategies, such as attraction and retaining large corporations. Startup initiatives that the state does have to put their money into, such as Ohio's Third Frontier program, benefit the high-growth technology sector. While this is crucial, it's very valuable, and it neglects a large portion of Ohio's potential employers, small businesses that employ 5 or less employees. As a result, we have to spend a lot of time screaming and yelling and trying to get in front of Ohio Department of Development and now Jobs Ohio people and explaining our story and why small business, really small business development is crucial for job creation. Without continued federal support and education on the state level, microenterprise will not have the opportunity to create the jobs that we have the potential to create. As you can see, with each challenge, we try to look for creative ways to continue to meet the capital demands of Ohio entrepreneurs and micro businesses. Thank you for the opportunity to communicate these challenges we face in serving small business. Hope this testimony is useful as you return to Washington. One other example I would like to give on our regulatory burden is we were the recipient of Small Business Loan Fund dollars, SBLF dollars, with a small allocation in the form of a loan, a low interest rate loan, which is how we get a lot of our capital, like SBA capital and our bank capital. And it seemed like a good idea at the time. It was $203,000, which we've now deployed all of it into small business. However, the process took approximately 6 months. We had auditors in from 3 different states, which is probably all good shepherding of federal dollars. And then the closing, I went back and forth with the closing attorneys from New York, I think 16 times to get the actual deal closed. So I can imagine that our $203,000 loan probably cost, I don't think about what it cost, but it's quite an expensive deal. So I think that demonstrates some of the regulatory burden we face as well. But thank you very much.
And our final witness is Mr. Martin Cole, President and Chief Executive Officer of the Andover Bank. Welcome. Thank you.
Thank you, Madam Chair, Congressman Duffy, Congressman Renacci. Thank you for bringing this hearing to Ohio, for your invitation to testify today. My name is Martin Cole. I am President and CEO of the Andover Bank. We are a rural, state chartered community bank with $330 million in assets and have been there since 1884. I've been there 36 years. Viewed from enough distance to gain perspective, the structural flaws in our financial regulatory system are clear. In the early 20th century, the average consumer or small business had one resource for financial services, a bank. Thus, policymakers viewed banks as vital to public's interest, and Congress enacted safeguards. Deposit insurance and on-site regular examination provide 2 examples. Please note, banks pay the entire cost for both. The marketplace constantly innovates. Active regulation can impede innovation. If one path is blocked, the marketplace will blaze another. Significant government costs for banks push the marketplace to invent non-banks to avoid these costs. Simply put, bank supervision is far more intrusive and expensive to banks than government regulation is to any of our non-bank competitors. Let me try to reinforce the public policy importance of equivalent regulation with an Ohio example. Leading up to the collapse of the housing market, federal mortgage lending laws theoretically applied to mortgage brokers. But in Ohio, no one enforced those laws. As a result, Ohio suffered from rampant predatory lending as criminals and charlatans slipped through the enforcement gap. When Ohio belatedly licensed brokers, its process included criminal background checks. As I understand the numbers, an estimated 2,000 brokers who had been operating never applied for licenses. Of the roughly 10,000 who did, 14% were found to have criminal backgrounds. My bank's primary marketplace is a single county. For my bank to prosper, I must invest in the communities we serve. As a small bank, my sustainable competitive advantage is that I can know my customers. Thus, I can safely make a small business loan that another bank, relying only on credit reports and credit scores, would rationally deny. Across Ohio, there are thousands of successful businesses, some grown large, that exists because of the initial insights and hands-on help of a community banker. For that process to work, the regulator must allow us to use informed judgment. Today, what I hear from peers is they feel that bank examiners are not allowed to respect the judgment of skilled bankers. Let me be clear that I believe the financial services industries should and must be regulated. I have enormous respect for my regulators. Their job is very important and very, very difficult. Let me turn to consumer regulations. As a community banker, I will succeed or fail based upon my reputation. We have powerful incentive to work very hard at treating our customers fairly and in helping them make decisions that are best for them. We understand there are bad guys in the marketplace and that we need consumer protections. However, for a smaller bank, every change in a regulation imposes real cost and distracts my colleagues from our customers. That's okay if the consumer gets a benefit that outweighs the cost. Far too often, he or she does not. The Ohio Bankers League, which represents Ohio's banks and savings and loans from the smallest to the largest, operates an online exam evaluation system. The system is new. Its purpose is to provide useful feedback to agencies to help them improve their procedures and training. Evaluations of recent exams give cause for concern. 42% of the participating banks reported that their examiners were neither flexible nor open to the exchange of views. Less than half of the banks believe their examinations had resolved issues and commended corrective actions in a fair and reasonable manner. I would commend two bills pending before the House. The first is H.R. 3461. We are encouraged by its clear focus on timely, fair, effective examination. Finally, while I understand that H.R. 1697 content is too diverse to be considered by a single committee, I would ask for your review of those provisions under your jurisdiction. Please understand that redundant regulation or regulation designed for larger, more complex institutions can severely harm the ability of a small bank to respond to the legitimate needs of its community. I want to specifically thank Congress for recently raising the SEC shareholder threshold from 500 to 2,000. That single change will make it far easier for smaller banks like mine to raise capital in the future. We have 460 shareholders. We have a list of individuals who would like to buy our stock. We can now proceed with capital expansion plans without fearing costly additional regulatory requirements. Thank you. In the movie It's a Wonderful Life, George Bailey had a crazy Uncle George who unintentionally and inadvertently almost destroyed the financial institution he loved. I have a crazy uncle also. His name is Uncle Sam. His name is, I believe, he is inadvertently and unintentionally destroying community banking. Maybe you can be my Clarence. I am grateful for your interest in Ohio and its communities. I would be happy to respond now or in the future to any questions you might have.
Thank you. Thank you all very much for your testimony, and I think we have a good variety here, so I think we get some good questions. So I'm going to begin with the question and answer portion. And Mr. Blake, I want to ask you about the Volcker rule. It's knowing the complications of it, and I'm glad you mentioned that the Senate was making a move to postpone this, but there has been a rush to get this onto the books and sort of in the barn. But the question I have is, you talked about safety and soundness, and what is the compliance cost? You mentioned disproving a negative, so disproving that you're not engaging in this. Have you been able to calculate what the compliance cost would be to Key Bank? I mean, have you already hired people to try to meet these challenges?
We have not. We're waiting for guidance and final rule winds up. The proposed rule would certainly require us to provide these higher compliance officers. But the reach of the Volcker rule is so extensive, it requires significant record keeping, significant analytical work, significant testing. The compliance program that's part of the rule has to be
there's actually been a lot of criticism too about the international implications of what this rule could mean to our financial institutions. I want to get to, I think Mr. Hanning and Mr. Cole mentioned this in their testimony. I was at a small bank in my district over the holiday, and this whole theory, or not theory, but I guess I don't want to say fear because that might be too strong, but consequence of community banks sort of being swept under and really being forced to either merge or be acquired because you can't meet the compliance costs is really going to, I think, endanger that one-on-one personal relationship. A lot of times, your bank's gone back, what would you say, 200 years or?
It was 1884.
Yeah, 1884. I'm sure you have relationships with probably everybody in your community and know a lot of folks in your communities. In my bill, in the examination bill, we're trying to get the consistency in there, the timeliness of it, the ability for you to have questions answered and to appeal certain decisions. Have you, in your experience, through your examinations, tried to appeal decisions that have been made? What's been the result of that? Not yes or no, but really, do you have frustrations with that, I guess is what I'm asking.
Not specifically in the safety and soundness area. We do in the compliance area. And we just recently, because of the time period between examinations, 4-year period, and my discussion with the policymakers at the Federal Reserve was that there was too much of a gap in communication, lack of understanding of what they wanted versus what the regulations state, because there is a lot of nebulous interpretation under the guise of fair lending. And as an example, we recently, I've had been forced to go out and hire a full-time compliance officer, salary and benefits of about $60,000 a year. We are currently employing the services of a consultant at $1,200 a day. They're spending about 2 days a week, and they're just coming in, assessing what we need to do, trying to interpret in anticipation of rulings coming from the CFPB or any other agency. And it's the uncertainty and the unknown that we most fear. This afternoon, and our bank is doing quite well. We're coming off of our 3rd consecutive year of record earning. So it's not that we're struggling in this market. The concern is the future. And this afternoon, I'm returning back to the bank, and I have an appointment with a gentleman from a much larger banking institution to discuss the possibility of merger. So it's an option we have to consider for our shareholders. Unfortunately, it would be a huge loss for our particular area because of the services we provide.
What county are you in?
Asheville County,
Which is up to
the very northeastern part. And we have the #1 market share in Asheville County. We are a significant financial institution playing a significant role in our community. And it would be a tremendous loss. But the reality is, what we see the headwinds of compliance, based on our size, we feel we have to generate a larger size in one fashion or another to absorb the cost, just to meet regulatory requirements.
I'm going to move to Mr. Renacci, but I'll get back to Mr. Hannon on our second round. But I'm sure this will give you great comfort to know that one of the top 10 fastest growing occupations in this country is compliance officers in the financial institution. Compliments of Dodd-Frank, I'm sure. So, Mr. Renacci, the question.
Thank you, Madam Chairman. I do want to thank all of you for being here after listening to all of your testimony. It continues to reinforce some of the concerns that I have with, over-regulations, and even Mr. Fireman, your comments about certainty and predictability. Without certainty and predictability, things get frozen up too. So I appreciate that. I will open this, excuse me, next question up to anyone on the panel. Secretary Geithner has stated that FSOC will coordinate an interagency review to identify and eliminate regulations that are outdated, unnecessary, or unduly burdensome to insured depository institutions. Have your trade associations been active participants in this process? Based on the agency's work to date, should we be optimistic that their efforts will yield constructive recommendations for reducing regulatory burdens that your institutions face? Again, anyone on the panel would want to address that.
I can't say that I've seen any efforts on our part from our association. Fortunately, it sounds like a little bit of government rhetoric. I'm sure they don't want anything to happen that would cause undue harm to the financial institutions in Ohio or across the country. But in the efforts, obviously, from Dodd-Frank and the interpretation of much of what we have yet to see, I can't see the efforts of reducing burden more so of increasing.
If I could respond to that also, our association works diligently to work with all of the agencies, whether that's reviewing new rules and regulations on behalf of credit unions and then filing comment letters with respect to all of those on potential consequences or alternatives or things like that. So our association certainly does. What we hope the outcome of that will be is to bring an element of common sense back into this regulatory process to eliminate those things that are of no value, that simply increase costs and minimize the ability of local financial institutions to serve consumers and to restore some common sense to the process. My colleague from Andover Bank is $350 million, if I understand that correctly, and he just spoke to you about the incredible amount of effort that they have to input to comply with that. Because I said in my testimony, 65% of the credit unions are 35 million or less. That's 1/10 of the size. So you can imagine complying with those same rules. So we certainly are hopeful that any process to minimize, streamline, and eliminate burdensome and duplicative regulations will be successful. We'll play.
Mr. Blake, I'm going to come back to the Volcker rule. You know, the Volcker rule was championed as an easy solution. Simply stop banks from taking excessive risk with federally insured deposits, and we would have all the answers. The argument was that banks could not engage in proprietary trading for financial systems would be safer. However, reinstating the 1930s regulation in today's complex financial world, of course, has proven to be very, very difficult. When regulators went to draft the so-called easy fix, the result was a 298-page proposal that included more than 1,300 questions, seeking comments on nearly 400 topics. Defining proprietary trading is not an easy task, is it? Why is it so complicated?
I think it's complicated because, well, in fact, I believe people themselves said proprietary trading is one of those things that you know when you see it, otherwise it's very difficult to detect. I think that the difficulty is that when Congress and regulators think of proprietary trading, they think of the larger institutions, the money-center banks, investment banks. Those institutions had proprietary trading desks. They gave their desks a certain credit limit, a certain dollar amount, and allowed them to trade for the firm itself. So they were buying and selling securities, derivatives, credit default swaps, and making money or losing money for the institution. Most banking institutions never did that. Most banking institutions focus on their core business, which is providing deposits, loans, and other traditional banking services. Mr. Barnes used a phrase earlier that I think is really appropriate here. We call it regulatory micromanagement. That's really what we see with the Volcker Rule. What the agencies are doing is trying to find surreptitious proprietary trade in every program. So if we are engaged in asset liability management, for example, have a fixed rate loan portfolio that we're trying to hedge, we don't do a perfect hedge. We make money. And oddly enough, making money is one of the conditions of proprietary trading. So it is micromanagement over regulation. Certainly micromanagement in the pieces of business that make proprietary trading.
Just a quick follow-up, and you said this in your testimony, you know, in addition to raising costs, how could the proposed rule actually increase the risk to the financial system?
Well, if we're not able to do asset liability management, that leaves us exposed to risk. It's an old system. Taking deposits at one rate, bank loans at another rate, and the difference is the spread that we make. When we make fixed rate loans, we have to hedge against the possibility of interest rates rising. Variable rate loans, we expect interest rates to drop, and we hedge that. So we have a very complex, fairly sophisticated asset liability management system. What the rule does is it requires us to look at that after the fact and say, if our hedges are not perfectly correlated, we praise the regulation is reasonably correlated with risk. But the problem with regulations, except in hindsight, if we weren't able to predict the degree of increase in interest rates or the timing of increase in interest rates, our hedges may actually make us money. And curiously enough, that would can't be an issue if we're engaged in financial trading. And that's why I say that one of the fundamental problems with this regulatory micromanagement, getting into the nitty-gritty of asset liability management and looking at it on that factors.
All right, Mr. Duffy.
Thank you. I come from a rural part of Wisconsin. I grew up in a town that has roughly 2,000 people. The bigger Wall Street banks necessarily weren't participating in my community. We had small community banks. I spent my adult life in small rural parts of Wisconsin, and I've had an opportunity to deal with the smaller banks, and I had a chance to deal with the larger institutions, and the larger institutions do good work. But I guess I see the value that the smaller banks provide for rural areas across America. And one of my concerns is the rules and the regulations that are coming out have a disproportionate impact on the small credit unions and the smaller banks, and that's compared to our, obviously, larger Wall Street banks. And I guess if you look at the background as to why we're seeing all these rules and regulations, it might be from some bad actors that Mr. Cole referenced, but also some of the behavior that was taking place on Wall Street, and not necessarily the behavior of the financial institutions that are before us today, but the smaller institutions that didn't have that role in the crisis are bearing the brunt of now the rules that are coming out. Am I misguided in my comment or analysis on how I'm seeing this?
No, I think you're dead on, Representative Duffy. We certainly believe that what you're saying is true. We see you're exactly right. Credit unions that I represent had no impact or cause or weren't the cause of the financial crisis, but yet we see regulations being written to the lowest common denominator. And our credit unions have always worked with many community banks, have worked with people to get to know them, to treat them on a one-to-one basis, to give them a fair and honest deal from the very beginning without ever being pulled to by Congress or a regulatory agency. But the problem is with the regulations when they are so onerous and designed to curtail certain awful behaviors that created such a problem, there are so many unintended consequences that we see that inhibit a small credit union or any credit union's ability to continue to provide that working one-to-one relationship without a huge burden of regulatory experience. So we believe you're right on.
Congressman Duffy, I agree wholeheartedly. I'm from southeastern Ohio. My financial institution is $110 billion, so I'm about the third size of these guys. I'm about to right. I also had to go to a full-time compliance officer, 50,000 plus benefits, which prior to 5 to 7 years ago was about a third to half position. 20 hours a week would be max for compliance, and now I have a full-time compliance with some help, plus pay an outside audit to check the rules and regulations. Unfortunately, community banks get caught in the trickle-down effect of rules and regulations that are set for larger financial institutions. They have a rule, they have a good position, but I have a large institution, one block to the left, my main bank, one block to the right, my main bank. They both offer the same products that I do. They're mandated by law. They set the price for lower standards or lower pricing. Where's your customer going to go? Is he going to go to the big guy at a lower price or come and see you and pay more. So we, in effect, do trickle down, have to comply with rules and regulations that are set for all financial institutions. Good examples of that are the debit card fee structure. We were mandated in the amount that we could charge for processing debit card transactions. We complied. We made some noise and squirmed a little bit, but we complied with some mediation and got the price up a little, but still below the cost of doing business. The merchant has taken that and run. Home Depot and Fortune 500 companies are announcing to their shareholders that they're going to have increased earnings from the debit card fee. They're not passing it on to the consumer. So while the bill man had good intentions, it never got to the bottom line. Those are issues. We also have the same issues with the examination process. My bank is on an 18-month cycle. Over the last 3 exams, I've seen a force of examiners come in, completely different, new faces. I had some disagreements. We are a highly rated, well-capitalized financial institution. My earnings have stayed the same over the last 3 years because of increasing expenses. I had the opportunity to have to call a district office. I had some discussions with them. Didn't get the answer that I wanted or thought was appropriate. Finally, I ended up talking to people in Washington. So the next exam came in. I had a whole new team. We had a wonderful examination. But some consistency, I guess, is where I'm going with that. I think the biggest problem we faced was not knowing what to expect when they walk in the door, and then sitting there not knowing when we're going to get to it from them.
And I put the same thing in Wisconsin. But to the point of, if you look at the small institutions and the impact that it has on that institution, the new rules and regulations, as compared to a larger financial institution, is it fair to say that a larger institution has a broader base to carry those costs over as opposed to a smaller institution, and therefore the burden isn't equally borne by the larger and the smaller institution? It's unfairly placed on the smaller institution. Is that not right?
Oh, absolutely. Your perception of what exists up there is exactly right. And many legislative individuals have indicated that same thing to me. And even at the beginning of the crisis, my own representative, my own senator told me, we understand you're not the cause of it. We will make sure that this doesn't impact you. We were in Washington last month. We spoke with Governor Renacci of the Federal Reserve. She also indicated her understanding and sensitivity to the community banking industry. I've read many articles about, that stating from Chairman Renacci, again, the sensitivity to the community banking industry. I think there is a feeling of sensitivity towards our industry, and again, an appreciation, and I think truly a love for our industry by the public, and I feel by Washington. The disconnect is in its execution. The policymakers, I think in theory, believe that there should be some kind of different regulatory system for large and small. They don't know how to execute, quite frankly. And my complaint to Governor Renacci, my complaint to the policymakers here at the Cleveland Fed, is the lack of understanding of the theoretical application of policy and the execution in the field. The intention is not being carried out. My compliance examiner bragged about his years of experience of working as a compliance individual for a large bank. He was already biased by what he had known and seen in large institutions and was expecting the same from us. And I think was surprised at the lack of sophistication that we displayed. Well, he didn't have the understanding of the differences in the different institutions. Many of the examiners again just don't understand how we can operate the way we are, safely, soundly, profitably, without the sophistication. And and quite frankly, it is challenging. But we are able to do it because it's different. And I think that theory and philosophy is where it gets disconnected through the system, because obviously it's a bureaucratic system.
And maybe to that point, I know we got to deal back in 1 second, but I think it's true, there's an affinity for the smaller financial institutions. And I think we've seen the difficulty in saying, how do you structure one set of rules for a small institution as opposed to a large institution? I think that can be problematic, and there's a lot of struggle with that. But I think that goes back to the point that if you continue to overregulate and have all these different rules and not use a scalpel to make sure you have reforms in place that actually address the lessons of the crisis, but instead you use that crisis to wildly expand government influence in the center, the net impact is borne by the smaller institution. I think that's what we're seeing in trying to make sure we have a structure in place that allows that weight to be lifted of everybody. I think allows you all to get how many times I'm going.
Yeah, I'm gonna, if you don't mind, we'll do another round, because I have a couple more questions. I wanted to ask Mr. Fireman, you mentioned in your testimony the unpredictability of the Fed funds, and then you mentioned two funds that you get from the CDFI. Was the other one SBL?
Yeah, SBA, we're a microloan intermediary, so we borrow money from SBA, and the uncertainty there is not necessarily the ability to borrow funds. That's been pretty consistent. As an intermediary, each organization or agency can at any one time borrow up to $5 million, that's just got raised. And then as did the definition of a microloan.